trying to time the market is impossible. Trying to see exactly where things are going to go and know when it's going to happen is impossible. So long term, what's your ultimate best bet? Provided that you've got the risk tolerance, provided that you've got the time frame, provided that you've got, the capacity to do so, is your best bet is usually invest in good quality assets, invest for the long term, and don't try to time the market.
Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics such as investing, cash flow, budgeting, saving, passive income, debt management, and much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Bills, I'm back.
Andrew, you are back after 1 week of hiatus.
Yeah, exactly right. Exactly right.
Good to have you back in the recording studio.
I'm going to blame it on childcare and all of the illnesses that come with it. So to all the parents out there, I'm sure they'll know exactly what I'm talking about.
Exactly right. So not only does it hurt the hip pocket, but it also gets you sick and
build up their immune system.
Gives you time off work.
Your own immune system as well.
Yep, that's it. Andrew, what are we talking to everybody about today?
Yeah, so today we are back with a market wrap. So we're going to talk a little bit about what's been happening in investment markets and how things have been transpiring over the last month or so.
Awesome.
It's been a little bit chaotic.
There's a bit going on.
Yeah. I think the US is really the standout story in all of this.
No doubt.
It's all right. We'll get to that.
Just to time stamp this or date stamp this, we're recording this at the end of July. So the data that we're talking about is basically the last month.
Yeah,
essentially. Okay, so we might start in the US because that's probably where most of the action's been happening, and I can't wait till we start talking about the US election because there's a few juicy things happening there. But for the past month, the S&P 500 index is down 0.77%.
Yeah, so S&P is down. Now, when you sort of look at that as a headline figure, it obviously isn't great because everyone likes to see investments increasing and going up. But when you take that into the broader context of how well the S&P has been doing over the last 12 months or so, we're still at a very, very positive position. But Bills, it was a bit interesting. I mean, it wasn't your normal story. I think previously S&P 500 has really been kept up by the Magnificent Seven or the Fabulous Five, whichever you want to call it. I know where they pull their superhero nicknames from. Very American, very Hollywood, but a little bit of a different story in terms of what's been pulling the market up in the US.
Yeah, look, I mean, you talk about the last 12 months with the S&P index, and we've seen significant growth, 26% predominantly driven by the big technology companies that we all know and love. But looking over the past month, it's actually changed, and we've seen that coming from or the growth that we've seen has been in smaller companies. So some of the bigger ones have come off, but the smaller ones have picked up. And that's due to the sensitivity around lower interest rates. So we'll talk about the outlook for the Fed and what that looks like in terms of rates. But basically, we've seen some of the smaller companies start to step it up a little bit, where predominantly over the past, say, 12 months, even a little bit longer, it's just been dominated by the big technology companies on the market.
Yeah, exactly right. And look, a lot of that has come from sentiment around interest rates. So the expectation is that the US, at some point in time in the near future, I mean, you can pick your time frame. Some people are saying, one cut before the end of the year. Some people are saying 2. Some people are even saying 3. But at some point in time, it's pretty imminent that the US is likely to be dropping interest rates. And the smaller companies are much more sensitive to that information. Smaller companies tend to have a larger amount of debt on their balance sheets. And so the impact and the sensitivity around interest rates to those smaller companies is going to be a lot more, which is why we're seeing that aspect of the US market picking up more so than the tech-heavy sector.
Yeah, and that's not surprising. I mean, we'll talk about Australia a little bit later on, but that's different to what we're experiencing here, where market sentiment around what interest rates are going to do, I think, are a lot less subdued, or a lot more subdued here in Australia. And we're probably not as optimistic as what's happening in the United States. In saying that, I think the states have done a better job at taming inflation than what we have here, keeping in mind that the mortgage market over there is different to how it works in Australia, where you buy your packet of money for your mortgage, you buy, and that's your rate for the life of the loan. Whereas in Australia, we're on a variable rate, so it does change in line with the Reserve Bank and what the banks get their funding at. But we'll get into that a little bit later. Andrew, let's get into US politics, because there's been a lot happening. I was reading some stuff in preparation for today as well too, but US politics. I mean, we can't talk about this without talking about the Trump assassination attempt. So we'll start with that. I don't know why I'm smiling.
I feel like we're living in
a movie.
Yeah. I mean, it's crazy that you're thinking and talking about, particularly when you're talking about the Western and the developed world, an assassination attempt on a political leader and someone who's vying for the president of the US. But we're going to try and maybe look past a little bit of the politics.
I don't know why we're smiling and
the news associated with it. No, it's a horrible thing. But it's just
a joke, isn't it? It's just a joke. Yeah.
But as a result of it, just to add a little bit more, fuel to that fire, is the odds of Trump getting elected has increased significantly off the back of the assassination attempt. So what we're now starting to see is the market is pricing in the expectation that Trump is going to be the US president. Now, we still have until November, so things can change very quickly. We are still talking about a 3-month time frame, more or less.
Mm-hmm.
So that can change, but it's impacting expectations around where things are going to land in the US.
Yeah, look, it's interesting. I mean, you talk about what's happening with the Democrat Party as well too, with Joe Biden standing down essentially and not re-running for the presidency. He's named Kamala Harris as his endorsed candidate, but the Democratic Party, at time of recording anyway, has not endorsed her yet. It's highly likely that that's going to happen anyway. But yeah, you're absolutely right in terms of this just feels like a movie, and it's almost comical in terms of the stuff that's going on. I look back at the assassination attempt and I'm like, how can this even happen? Maybe I've watched one too many Hollywood movies and, the Secret Service have got stuff locked down, but you see some footage, it looks like an absolute circus.
Oh, absolutely.
And I hope that's not how they intend to run the country.
Yeah. to have someone with a rifle that's, 100 yards from the president and that not get sighted is absolutely crazy. But we're going to hold the conspiracy theories.
I think it did get sighted. That's the thing. Anyway, let's stay on point, Andrew. Good talk. So we were talking about interest rate cuts potentially happening in the US faster than what we're expecting in Australia. One of the things from America's unemployment numbers, we're starting to see that slowly rise. So then that ties into, I guess, the expectation around an interest rate cut, because you're trying to get that fine balance between unemployment, making sure it's not too high, still growing your economy. In saying that, Andrew, you might have some more information around this, but that was due to the auto plant shutdowns that were happening in the United States. So a fairly large industry when you think about that from an employment perspective. What does that look like?
Yeah, so look, it's not enough of a trend for it, or it's not enough of a consistent trend for it to actually be a trend in employment significantly rising. So what we're talking about is 1 month's worth of data in terms of unemployment rising slightly, but there were some large auto plant shutdowns which really impacted those numbers significantly. So that was a contributing factor. One of the other things as well is, as the market's pricing in the likelihood of a Trump election, there's also the few underlying policies that are also being priced in as well. So some of the big key initiatives that Trump has stated that he wants to do is higher tariffs, so imports into the US becoming far more expensive, lower immigration into the US, as well as tax cuts. So what that's likely to look like, assuming that all of those things get through, is lower growth but higher inflation, which is contrary to the interest rates and everything that everyone's been doing to decrease interest rates. So whether that plays out or not is, there's so many more dominoes that need to fall before we eventually get to that stage. But taking into account lower interest rate environment and the likelihood that Trump's going to get elected, which obviously can change significantly, does mean that we might actually see some uptick in inflation in the US. And who knows what that's going to mean for the Fed and what they're going to do with interest rates in the future. But nonetheless, the likely outcome at the moment is that in the short term, interest rates will be coming down in the US.
Borrow more money and reduce interest rates. That's the playbook.
Yeah.
So we'll see. Let's pivot across to Europe, European Central Bank. So they have kept rates unchanged at their last decision, remains at 3.75%. Andrew, what else are we seeing over in Europe?
Yeah, so that's off the back of ECB being one of the first major banks to drop interest rates in their last meeting. There hasn't really been a commitment for cuts for a second time in September. There has been some sticky services inflation in the US, despite the fact that inflation more broadly has been coming down. But that seems to be the sentiment both in the US, in Europe, in Australia. Services inflation has really been quite sticky worldwide. And now the growth in the Eurozone, the market is pricing in that it's very likely that it's tilted towards the downside. So a little bit more economic uncertainty in the European markets at the moment than what we're seeing sort of across the US and Australia.
Yeah, and there's been, for a while you've heard that the term being sort of thrown around, lower for longer, in terms of the amount of growth that we can expect. And I think you're absolutely right. In terms of how all of this is playing out, it seems like there's a continued level of uncertainty. And what that does tend to do for businesses and companies trying to make profit, it just means that, they're not sure where it's going. So companies not sure where to invest in because they don't know what the outlook is going to be. Are they spending money on CapEx? And then if you sort of multiply that around the whole economy, then you've got, I guess, this sort of
a period of growth.
Yeah, tilted toward the downside is what you were potentially saying. So, then you take it back to interest rates, and if you're a government or a central bank, then obviously you're putting pressure on interest rates to come down to try and stimulate some activity.
Yeah, look, when it comes to the ECB, I think it's such an impossible task. And again, maybe getting a little bit off track here, but you're talking about a central bank that's really looking at monetary policy for the entirety of Europe. Like it's difficult to look at interest rates for one country and what the best outlook is going to be for that country, let alone an entire continent. It's not an easy. There's a lot of countries that just get caught in the crosshairs.
Yeah.
Unfortunately, it's not the best policy for them. It's only best for the big players. But anyway, that's another topic in itself, right?
We could probably debate the whole success factor of the Eurozone and what does that look like. How long's that been going for? That's been 35, 40 years now? And we're going to have to fact check that, but going to have to show my age. But if that's grossly incorrect, it is Friday morning. I definitely need another coffee. But let's pivot across to Australia. So we've seen over the last month, the ASX, this is the ASX 200, is up by 29 basis points. In terms of where we're at as a broader market, though, the Australian market, not as successful as the US because we don't seem to rally as hard, but we're at record highs.
Yeah. Exactly right.
So we're seeing some really good numbers come out of our stock market.
Which is very interesting. When you consider that there's still economic uncertainty, interest rates are still at very high levels, our debt levels are still incredibly high. The fact that our share market is hitting a peak is, at least in my mind, defying all expectation. But it just goes to show, and I find that in periods like this, it's very evident to say, there's economic uncertainty, borrowing is becoming more difficult, businesses are struggling more and more, inflation is high, the cost of living is high. So you talk about all of the things stacked in the negative, and ordinarily it's, okay, share market is going to be decline, and it's not. And so what principles does that show you is ultimately what I come back to, and it's trying to time the market is impossible.
Mm-hmm.
Trying to see exactly where things are going to go and know when it's going to happen is impossible. So long term, what's your ultimate best bet? Provided that you've got the risk tolerance, provided that you've got the time frame, provided that you've got the capacity to do so, is your best bet is usually invest in good quality assets, invest for the long term, and don't try to time the market.
I was going to say, come and talk to the team at 360 Financial, but that was just obvious and a given, right? That was the first thing.
That's the podcast.
Yeah, look, it's interesting what you're talking about. I mean, I think the economy and our population is probably more resilient than what we've given ourselves credit for. So I think that's interesting to point out and to note. But in saying that, when you look at employment, and we're talking about employment here, in the last month, this is the month on month in June, it's actually risen by 50,000.
Month of July.
Sorry, the month of July, it's actually risen by 50,000 people.
No.
I'm reading Andrew's notes here, and Andrew seems to have got that wrong. So ahead of expectations of 20,000. So a lot of this is because of the migration that we are expecting. But if you consider people coming into the country, needing to work, live, shop, do their thing, that's how an economy is made and how society is run and how commerce is done. So in terms of that resilience factor, we are still seeing some good numbers come through, even though, yes, interest rates are higher than they have been in the last X amount of years. So we've been used to lower interest rates. It hasn't been X amount of years. It's probably been a decade or so. They're just going back to some sort of normal state. Inflation is probably the one that we need to look out for. But from an employment perspective, employment is still relatively healthy. I guess just to raise the counter argument, what we're not seeing is the wages growth in line with the inflation piece. So that's probably the only thing there. But I'm saying that, looking at this, the economy is more resilient, which I think is a reflection of where we're at with the stock market.
Yeah. And look, I think the population growth is a massive contributing factor. And if you look at any economist, any professional person, the likelihood that Australia is going to experience population growth over the next 10, 20 years is almost certain. So what happens when you add more people into a country? Well, obviously it means that there's going to be a greater demand for housing. There's going to be a greater demand for goods, for services, for all of that stuff. And so depending on how much you want to zoom out, you can look at the short-term volatility. You can look at, some of the short-term concerns, but long-term, the odds are stacked in your favor.
Well, it reminds me of a great quote by the great man Warren Buffett about just investing in the S&P 500. And basically his theory is that you don't bet against the American people. Yeah. So it's the same thing. If you believe that, in the future we're going to have more people, more growth, more prosperity, then what you were just saying is accurate. So yeah, there's a bit of wisdom there from Warren Buffett that you seem to share, Andrew. So well done on that front. In terms of interest rates, I mean, this one's a really challenging one, and I tend to get a little bit shirty with this, but the market's pricing in a 22% chance of a hike in August, right? Now, the reason why I get shirty, and I know why they do it, is the word hike. They're not hiking, they're increasing.
Yeah.
But it sounds great. And a lot of the rhetoric around the effectiveness of it is not necessarily the movement itself. It's them talking about what they're going to do. They call it jawboning, but basically telling people that this is their intent. So it changes people's behavior around their spending patterns and so on and so forth without actually needing to pull the trigger.
Yeah.
I don't actually think we're going to see a rate hike or an increase as our next move at any point in time. I think the next one's going to be down.
I 100% agree with you. And this is very interesting. So depending on how you word that will ultimately shape your perception as well.
100%.
So there's a 22% chance that there's going to be a hike in August. Now that sounds like, oh my goodness, there's a chance that we're going to increase interest rates.
78% chance too.
There's a 78% chance that interest rates will remain on hold. So the very, very likely outcome that most of the market's pricing in is that interest rates are going to stay on hold, and that's likely going to be the next move. There has been some rhetoric as of late around interest rate rises. I think exactly. So sharing your sentiment, Bills, I think that it's very likely that the next move for Australia is going to be down. I think that it's still going to be a little while away, and so we're probably still going to see rates stay on hold for longer. But particularly with what's happening in terms of currency valuation as well, and the US potentially dropping interest rate in the near future, I think it's unlikely that we're going to see Australia shift in the other direction with interest rates up.
Yeah, no doubt. And look, coming back to, I guess, the RBA, and it's been interesting because they have changed leadership. There was a lot of talk around the previous governor in terms of the decisions that he made. Did he wait too long? What did he do? Whether or not the RBA has the gumption to be able to make the decision and make those hard calls, or are they going to pause a little bit, wait a little bit longer and wait and see? You see it in the United States. They obviously back their decisions and away they go. I think it's very, very difficult. It's very difficult to increase interest rates. It's very easy to decrease them. In saying that, if I was sitting in the chair, I'd want rates higher because it gives you more room to move in case you need to drop them.
Yes.
So when we're at record low interest rates, you couldn't go anywhere. But if you were middle of the pack, at least it gave you the ability to drop them a little bit if you need to. So whether or not the Reserve Bank, decides to make whatever decision at the right time, or if they play a little bit more conservative and just see how things play out, which is what I expect. So coming full circle, I think we're going to see cuts earlier in the US, and we're probably going to follow maybe 4 to 6 months afterwards.
Yeah, exactly right. When you look at sort of the share market and what's been a contributing factor in Australia, just to kind of highlight the impact that interest rates have on the share market, Australia has been the complete opposite. So we're seeing that the large caps have overperformed the small caps in the short term. So your larger companies have done a lot better, which really highlights that interest rate sensitivity and how smaller companies are more sensitive to discussion around interest rates and the movement around interest rates.
CBA share price, just invest in Commonwealth Bank.
That is not advice.
Actually, this one's maybe a tip, not that we can, but from a currency perspective, so if you're looking at traveling anywhere, the Japanese yen is very, very weak. So if you go to Japan, your dollar buys more.
Good time to be going to Japan.
There you go.
Absolutely.
I'm starting to think about that, which is the reason why I chucked that in. So wait and see. So
wait for the next podcast in a month or so. Billy's off. He's in Japan.
Thinking next year, maybe with the school holidays, but we'll wait and see. So, Andrew, what do you reckon? Well said, well summarised?
Yeah, absolutely. I think we've covered that well, and hopefully given our listeners and our viewers a bit more insights around what's happening in financial markets.
If you want some more information, reach out to Andrew and myself. Details are in the show notes. Or as always, make sure you like and subscribe. And we look forward to catching you on the next one.
Thanks very much.
Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amiridis and Andrew Nicolaou of 360 Financial Strategists Pty Ltd, authorized representatives and credit representatives of AMP Financial Planning.